All right, hello, I'm Gina Florzak, Marketing Project Manager with the CCIM Institute. Welcome to today's webinar, The Economic Five, Federal Reserve, Inflation Metrics, Confidence Measures, Earnings, and Housing. Before we begin, we have a special message from our 2023 Global President, David Schnitzer, CCIM. Take it away, David.
Thank you, Gina, and thank you everyone for joining us today. We are so happy to share this exciting webinar as a member exclusive benefit to start your year off on the right foot. This is just one of many member benefits that are designed to help you adapt and thrive in 2023 and beyond. Your CCIM Institute is dedicated to the advancement of your profession by providing you the latest advances and resources for education, technology, and opportunities to make your next big deal. We hope to see you also on April 15th through the 19th in Boston for our mid-year governance meetings. And we are so excited to announce our newest partnership that we will be joining with NAR for the C5 plus CCIM Summit and Global Conference, September 28th through the 30th in Atlanta. Through these member benefits, we hope to bring inspiration, innovation, and collaboration to you and all those that engage in the commercial real estate profession. Now, let's get on with the webinar. That's why you're here. Joining us is the CCIM Institute's Chief Economist, KC Conway, CCIM, CRE, MAI. He is going to examine 5 of the most significant economic indicators and discern what CRE may face this year. Please feel free to ask questions throughout using the Q&A tab. We'll also be answering as many as we can at the end of the discussion. And if you're experiencing any technical difficulties at all, please use the chat feature to help with that. We'll get right back to you. The recording and accompanying presentation will be emailed to all registered attendees. Casey, welcome, and thanks for joining us today. I'll turn the show over to you. It's all you, buddy.
Thanks, David, and good to at least virtually see everybody in the new year. Can you believe we've already knocked down the first month of the year? It's going fast. So we'll jump right into it here. I'm doing my part to fight inflation by cutting down from my top 10 or top 7 to just the economic 5. So I'm trying for deflation here in the presentation. We're gonna have a bonus 5 here. There's 5 terms I want you to look for in the presentation. One is called super core CPI. Forget core and regular non-core inflation and think about super core. Think about maturity defaults. This is going to be one of the big challenges and opportunities in the year, as all those that face refinancing are going to find there's no cash for nobody out there. Boo leisure. This is just for Carl Landro. This is the business hospitality that's doing very good, but we're combining remote work and some leisure, and it's Boo Leisure for Louisiana. Band of investment for cap rates. Many of us forgot this technique, but we're going to be dusting it off. And then I'm going to close on SpacE-nomics. This is a new big part of the economy that, believe it or not, even the Bureau of Economic Analysis is breaking out from GDP. So the bottom line, what we're going to discover is this year we're going to transition from what we were all taught many decades ago, which is real estate's all about location, 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 to what I've been advocating for a number of years. It's really location, timing, and capital. The timing isn't so good with the Fed and inflation, and the capital, it's all locked up. So we will just jump right in here. Here's my normal disclaimer slide. We'll skip past that. There's my background bio for those of you that are new or new members that don't know my background. There it is for you as well. So let's jump right in with the first of the economic 5, the Federal Reserve. So this Federal Reserve, if it's felt like the rate increases from last year have been pretty severe and steep, you were right. This is historically the fastest rise in interest rates and rate movements by the FOMC in its history. See the red line there with 2022 in the chart. And what it's doing is it's locking capital up, because essentially what the Federal Reserve is saying to banks is that lending is economic activity and economic activity is inflationary, so quit lending. And that's what's happening. I'm hearing from many of the merchant developers and the brokers, big brokers and medium brokers around the country, that somewhere between 1/3 and 40% of all CRE transactions that were dependent on debt and debt structures that thought they had commitments at the end of the year all fell apart because those capital commitments were pulled or re-underwritten at more like 7 and 8% interest rates instead of 4 or 5%. Property owners and borrowers with refinance needs in 2023 and 2024 are going to face what we call in the capital markets maturity defaults. TREP is one of the best resources out there out of New York. It's tracking this, and they're seeing the numbers look tame right now, but they're forecasting them to quadruple or more by the summer here, and it's going to be especially bad in office. As really there's no capital options. The TREP description that they had that I love is drama, thriller, or chainsaw massacre. And it's going to be different by geography and property type. I fear we face more of a chainsaw massacre with our office. Pay attention on the right over there to the FOMC meetings. So you know we have one in process right now. We'll probably get a rate increase tomorrow. I don't buy this 25 basis point increase that everybody's hoping for tomorrow. I'm thinking it's another 50. The Fed is below the 5% target, 5 to 5.5% it wanted. It's in the 438, 440 range. It wants that in the 5.5% range. So that means we still have 75 basis points to go if we believe the Fed that they're going to stop at the 5.5% overnight bank lending rate. So that would mean a 50 tomorrow and a couple more 25s and maybe one more before the spring. Remember, there's no meeting in February and there's none in April. So the Fed takes off February to follow Groundhog Day. They take April off for spring break. So really, it's going to be March or May before we really understand what this Fed's going to do, how they're reacting to the inflationary news. Everybody seems to be thinking that inflation is tame and it's going away. And I'll talk about why I don't think so, and I'm not in that camp. All right, here's a bit on the maturity defaults. So office CRE is going to be the most affected, particularly in urban areas. And so you can see the retail has also been affected. It had at year end the highest delinquency rate. It increased about 13% to 8%. Well, that looks like a small percentage number to us. In capital markets, that's a pretty big number. Multifamily commercial real estate was up as well. Its rates went up to 2.6%. So multifamily is not going to completely escape, but I don't see a fall off the cliff on multifamily. There's a lot of capital that wants to go there. And remember, multifamily has that unusual capital source for it. The GSEs, the government-sponsored enterprises, Freddie and Fannie, and they put a lot of that on the Fed's balance sheet. The Fed is still buying mortgage-backed securities. So as long as the Fed continues on that path and is just dumping treasuries, we're probably okay on multifamily. I put an example here under office CRE on the right about, showing it's not all New York and San Francisco and Seattle, but look at Denver. So I grew up in Colorado, loved Denver, was just out there over the holidays, went to a Denver Nuggets game, to the Colorado chapter. My son loves your Rocky, the mascot there at the Nuggets. You're first in the Western Division. Been a long time since I was a kid that the Nuggets were playing that well. But anyway, maybe put some people in the office buildings while they're visiting a Nuggets game at Ball Arena. They've got a big 1.3 million square foot tower in the CBD that's got a big maturity default, and that could have a big impact. And so then down there at the bottom, you can see one property type that is going to work contrarian to what we've experienced in recessions. Usually hotels get beat up in a recession. They're one of the first things that goes kind of in the, down the drain. I don't think that's going to happen this time. And one of the things that's happening is since we can work remote, we can extend our business trips to include a little bit of leisure. So when you combine the business with the leisure, those markets and those hotel assets are what we now call blue leisure. And so I recently was out in Salt Lake City for the chapter out there, was recently out in Long Beach, in a number of your chapters. And they have great opportunities to extend the remote work and that business travel. And so those are going to do pretty well. And I see them performing well and not going in the toilet. This is going to be an unusual one for hotels. All right. Small business loans and the rise in defaults is really concerning me. So the U.S. loan default rate for business lending was really tame here at the end of the year, less than 1%. But the forecast down there at the bottom are this to go to 2 to 2.5%. That's a big rise. And so why should we care about what's going on with business loan defaults? And the answer quite simply is those are many of our tenants. So those of you that manage retail centers or own them or multi-tenant office buildings, you know that a lot of these small businesses like ours, Beverly, Keith, and I, we're in a small business space in Wake Forest. And what happens to us and what we decide to do, this is what happens to our real estate, these small business rates. So really be paying attention to the National Federation of Independent Businesses and what's happening here, because this could be affecting a lot of the occupancy in your smaller retail and office assets. All right. So yeah, thought we were done with retail store closings, and you were wrong. So we've been dealing with the retail apocalypse for a decade, and it continues. So I grabbed here a great resource that kind of keeps track of some of this. Is at the bottom in the link here. But I just pulled since January 1st some of the big name retail store closings: Starbucks, Walmart, Walgreens, Target, all of them, Party City going bankrupt, Old Navy, Nordstrom. All in all, it's already over 1,500 store closings in the first month of this year. And we peaked at 9,300 in 2019, and we're on track to go probably well above 5,000 into the 6,000 to 7,000. Now, many out there might say, but yeah, we're opening more stores than we closed. And that would be true in terms of the number of stores, but those new stores are much smaller. They're not the 40 to 100,000 square foot big boxes or the mall assets. These are small, 10,000 to max 20,000 square foot stores. So it's just not absorbing the same square footage. And pay attention on the grocery front. We're seeing a lot. We saw Safeway and King Soopers merge. And then we see, I highlighted this Save-A-Lot, which really provides a lot of grocery to underserved communities. And they're finding that they just can't get the merchandise to go in the stores, so they can't have the sales to do the business. It's not that people aren't buying groceries in underserved communities or rural areas. They just can't get the groceries. They can't get the products, so the revenue isn't there. So really pay attention to what's also happening on the grocery store, but we're not done, and this is deja vu with retail store closings in 2023. All right. I'm going to give you a couple of must reads in this presentation. This is one of them. Each year, TREP does their annual year-end review. And you can go on the TREP.com website, put in your name and email, and they'll send you the report for free, so you don't have to buy it. It is a phenomenal dissection of what happened in the real estate market and the permanent debt market over the prior year. And so this is where my favorite headline is: are we going to see drama, thriller, or chainsaw massacre? And we're going to see a little bit of each of this. But I think we are going to see some chainsaw massacre in office in some big markets in the Northeast and the West Coast. I pointed out here a few of the things. They're ugly headlines and bad headlines. They do the good, bad, and ugly. And on the ugly headlines, you can see that early in the year, back in the spring, we saw the headline was sublease space, and what that was doing. Big tenants that had space, they continue to pay their rent, but they're trying to sublet it, and that undermines the rental rates for the rest of the office market. The story of malls continued. The Columbia University professors put out a research in June on the New York City office values, and that they saw them falling at least a quarter to a third, maybe even more than that. I represented a big New York client that packed everything up out of Manhattan, and they moved it to West Palm Beach. And those stories continue. Facebook, look at them saying we're going to reduce our office space. These big tech companies that announced that by the end of the year, over 80,000 tech job cuts. That's 24 million square feet of office space that's not needed by a number of tech layoffs. So these are some of the stories. Even on the warehouse side, you can see on the left in the bad headlines, we went through the story with Amazon being over warehoused and pulling back on deals. We see the 10-year treasury that, at 350 today, which makes no sense to me. We have a 2-year at 420. There's a 70 basis point spread. So we have one of the steepest yield inversions that we've had in history. And that's not abating. It's going on for a long time. So the other one at the upper right corner there that you can see is we have 353 office loans maturing by 2025. It covers 583 office buildings in primarily urban markets. All the buildings in large MSAs like New York and Boston and San Francisco, and 56% of these office loans are floating rate loans. And so you're going to hear a lot more going into February and March about the amount of floating debt in both the corporate market and the real estate market, and how hard that's going to be to refinance given where the rates are, and that banks really don't want to be lending. So let's look a little bit at the inflation metrics. So this has been a good week or so in terms of the inflation metrics, but it's a little bit of a head fake. And you've got to really spend some time to read through these. So PPI, which is the producer price index, which is kind of a leading indicator for what's going to flow through to consumer prices, because whatever the manufacturers are experiencing, they're probably going to pass on to the consumer. PCE, the personal consumption expenditures, which is the Fed's favorite metric. And then one of my favorite, the flexible CPI. So let's look at producer prices. So we saw the number come down. Everybody thinks it's better, but I want to point a few things out. Food, look at food. Food's running well over 10% into the 12 to 15% range, and that's what we spend a lot of our household funds on. And then look at construction costs down there in the bottom chart on the left. Construction costs December year over year. In December, we're up over 18.5% year over year. They're in that 15 to 20% range. So what the things that affect us to build new, develop new, to move tenants and rebuild that space, those numbers have a lot of inflation and are really going to be tough to work through. So in the producer price index, I'd encourage you to look at food and the construction numbers versus just the headline number there, because they tell a lot about both our households and commercial real estate. In the consumer price index there, you can also see on the 12-month average, while the all items looks tame at just a little above 5%, below 6%. Again, look at food and now look at energy. And remember what I've been telling you all year long is that we had negative GDP in the first and second quarters. And what didn't we have to help with that negative GDP and inflation the first 2 quarters of last year? We didn't have releases from the Strategic Petroleum Reserve. So that has been a huge influence on GDP and CPI inflation. And we're now seeing those energy prices come back up. We're seeing the end of those Strategic Petroleum Reserve contracts. We're seeing a lot of consternation in Europe, although they've not had as bad a winter and energy crisis, but we see China reopening, and that means China is going to suck up and have a lot more demand on energy. So my forecast is I think energy is going to stay above $80 a barrel. We could see it go above 100 into the 110 to 20 range. I don't think it goes back to what it was in 2018 of $142 a barrel, but energy inflation is back and food inflation is not tamed. So we have to be a little bit careful about, what inflation is being tamed and what's not, and what affects the household the most. The next one, look at PCE. So the latest PCE data said pretty good overall, 4.4% up year over year. It was 4.7 in the prior reading, but look at personal spending. Personal spending dropped 0.2%. So think about it. The PCE will naturally come down. It's not an indicator of inflation. It'll naturally come down when consumers quit spending. And that's what's happening. The consumer is pulling back. They're not buying as much. My favorite indice to watch is the CART index, CART cancellation by Coresight on this retail research. And they're finding that the cancellation rate for orders in our e-commerce box have gone from 10 to 15% to almost 70%. And so that's telling us the consumer is being much more reserved. But think about that in PCE. The Fed's looking at that as an indication of inflation. What is really an indication of is recession. And so if personal spending is slowing down and it's going negative, that's an indication we're going into recession, not an indication that inflation is being tamed. On the flexible CPI, the Atlanta Fed and the St. Louis Fed have teamed up, merged their two metrics, the flexible, and Atlanta has what's called the sticky CPI. And what you can see is both of those are running around 7%. The Atlanta Fed at 6.7, the flexible at 7.3. And again, you can see it came down primarily because of the use of the Strategic Petroleum Reserve and energy inflation coming down. But on a year-over-year basis, we're still above 7%. So I'm not in the camp that this inflation is at all tamed and that we're done with this story. All right, let's look at the confidence measures, because a lot of the economy and our real estate industry is really psychological. Excuse me a minute. So the three big ones are the University of Michigan Consumer Sentiment. So we just had a fresh read on that in the last 24 hours, and it actually came up. And consumers said they were feeling a little more optimistic because all the headlines are telling them that inflation's peaked and energy prices are below $3 a barrel or $3 a gallon of gasoline. So they're feeling a little bit better, but they're not digging in any deeper. So if they're pulling back on spending and e-commerce orders, I'd really pay attention to this. This is going to bounce around a little bit, but I do look at the University of Michigan Consumer Sentiment quite a bit. And what's happening there, you can see in June, it reached a record low of 50. Again, that was before the Strategic Petroleum Reserve was implemented, those releases. So as that fully comes out here in the next 30 to 90 days, Let's see what happens to energy prices and the consumer confidence. Let's also see what happens as they digest all of these job cuts. So I look at the Challenger Gray job cuts each month, and I look in particular in the tech industry, 80,000 cuts at the end of the year. The next one over in the top right, the National Federation of Independent Businesses in their Small Business Optimum Index, small businesses are getting creamed. A lot of them have variable rate financing on their loans. So these higher rates, the 2-year treasury at 4.20 is very hurtful to them. They're finding that the banks are not renewing because the Fed's telling them, don't renew loans, it's inflationary. And the NFIB just reported that this was the 12th consecutive month that the reading for small business optimism was below the 49-year average of 98. So really watch that one, and particularly in things like restaurants and retail businesses. The other one at the bottom is look at Wells Fargo, the NHAB Wells Fargo Housing Market Index. I mean, we're back to the 2009-10 housing recession, but the story is a little bit different of what's happening and what's affecting that. So it's not necessarily that home prices are collapsing and your home is going to go down in value. What really is going on are things like home cancellation rates. So here's Fortune magazine, worked with Zillow and Moody's, and they just did a fresh map that I presented out at the LA and Southern California CCIM chapter. And they looked at where they think that home prices will decline the most and where they'll go up. So the red is where they think it's going to decline. So you can see again, the West Coast and the Northeast, they're looking at 10% declines in home prices. But still, if your home went up 50% or more over the last 2 years, a 10% pullback still means you're in the green. Look at where it's green, where they think it's going to grow. It's interiors, inner mountain, and it's in the South. This is where you still have affordability. It's still where you have workforce migration going, and you have all the affordability issues. So this kind of shows three smart people, Zillow, Moody's, and Fortune, saying here's where they think the home prices are going to be. This is my big point on housing, the builder cancellation rates. So we're seeing these skyrocket. So KB Homes just reported at the end of the year for their earnings that they saw a 68% cancellation rate in new home contracts. So what's happening is those that put a home under contract to be built 90 to 120 days ago or longer were underwritten at maybe a 4.5% or 5% mortgage, and now they're looking at something that's 7% or higher. They don't qualify and they cancel the order, or they're fearful of a job cut or cancellation, and so they pull back. KB Homes is a very well-run company and public home builder, and see this kind of cancellation rate is very concerning. You want to see one that I really get indigestion over is look at D.R. Horton. D.R. Horton primarily builds on a spec home model. So many of their homes that they put in place, although they're more affordable and lower price, they're still in the $400,000 to $600,000 range. It's all spec inventory, so they're probably upside down. So in your region, in your market, really dial into what's happening with the public home builders, because it's really going to dictate what happens with housing affordability, home prices, and then again, the ability to attract in workforce that need housing. All right, I'm going to pivot to what we all should know by now. It's our CREPI index. So CCIM Tech, Site to Do Business, the Institute. We introduced this over a year ago at the National Global Conference in Pittsburgh. And so Stan Grakowski and Mark Seibert and Carol Campbell all did a great job. They pulled Crazy Me in to help them with this a little bit. So we introduced the CREPI index. We back tested it. We found it's very reliable. We looked at 10 key metrics that we looked at that are all forward looking, and we've been tracking those. And here's the bottom line that we've seen in CREPI. The all-time peak was in January of 2020. At 100, the baseline. Our lows, the historic low was in March of 2009 at 84, but we broke that record in April of 2020 at 81.8, below 82. In January of last year, we started out at almost 92. So why did it take so long for us to fall down to almost another new record low here and get down to 82.8 at the end of the year? Rivaling and going below our previous March 2009 low. Think about what happened. We had this Fed that went from no inflation to transitory longer. Forget we ever said transitory. And then, oh my God, we do have inflation in January, but we're too chicken to spook the bond market, so we're going to do nothing. We don't have a meeting in February of 2022 because we're going to go watch the groundhog. And so they came back in March and they said, wow, inflation's here. Didn't go away with the groundhog. You didn't see a shadow. So they said, well, we'll just do a quarter point. Then they took off April, went for spring break, and they came back in May and said, wow, this inflation story is very real. So they did a 50 basis point increase and then followed up over the summer and into the fall with 475 basis rate increases and finished the year with a 50 basis point increase. That's the steepest increase ever. Those rate increases didn't really start until late spring and the summer. So their impact on things like the metrics, the forward-looking metrics in CREPI, University of Michigan Consumer Confidence, NHEB Housing, the Green Street CPPI, the S&P 500 decline, all of those didn't kick in until we saw the full impact and the seriousness of the Fed's change in interest rates. And so that's why it took a while for the CREPI. It wasn't that it was wrong. It just was reflecting what the input was in the delay in the Fed rate increases. I write a narrative each month. CREPI's now monthly. And so this is the latest narrative we just updated for our 2023 forecast and our year-end numbers. And here's my forecast. So CREPI will remain in a historic low range of 80 to 85. I think it could go below 80 in the spring here, particularly if the Fed truly goes to 5.5% overnight bank lending rate, which I think they will do. So we could see a lot of pessimism come in here that plays back into those 10 forward-looking indices. There's a lot of damages in the CRE industry that I see carrying over from 2022. The most significant one is those job cuts. And so that's why I track those numbers quite carefully. And the second is all the confidence measures in CREPI. If the consumer, if the home building and the housing and the small business are all in the toilet, there's no way this economy can move forward or go into a growth mode. And I do not see the Fed cutting rates in 2023 at all. I have a Fed briefing coming up at the end of February. I did one at the end of the year. And they're all quite concerned. I think you'll hear in the press conference tomorrow that the Fed may slow. They may eventually get to a quarter basis point increase here in the spring, but they're not pulling back. They're going to keep it in the 5.5% range for quite a long time, well into 2024. So one of the big needs that we're going to need or have from our customers and our investors is, how do I deal with maturity defaults? How do I make the numbers work when I used to work off of 4% debt money and now it's 7%? How do I work on it when cap rates were in the 5% range that are now going to the 7 to 8% range? We're going to have to go through that whole transition. So in the bottom right, you can see the metrics that we put together in Site to Do Business and CCIM Tech that we're following. When you go, this is free, go to sitetodobusiness.com/CREPI. You can get the Excel worksheet or workbook. You can see the worksheets on each of these and see what's trending and how they've each happened. So very transparent. I preach this all the time. I presented it to the Fed. Esther George, who's retiring from the Kansas City Fed as their president, told me she wished you would stick around and have this to bring the FOMC meeting minutes. She's going to make sure that maybe Jim Bullard from the St. Louis Fed brings it to the meetings. All right. What does all this mean for commercial real estate values? That's what we really want to know here. So on this slide, we put the Green Street CPPI, Commercial Property Price Index. This is the higher institutional quality stuff. So this is the really good stuff. You can also look at RCA, or you can look at CoStars, which is more the mainstream commercial real estate. All of them showed that commercial real estate values peaked sometime in the third and fourth quarter of last year. And what caused them to peak and start to decline was we knew that expenses were running at a growth rate of 3 times what rents were. And so when you get that imbalance, you get some NOI erosion, even if you leave the cap rate the same. That led to about a 10% correction in prices, 10 to 15%. But what we haven't had yet is the correction from cap rates. So what happens when you go from a 10-year treasury that's in the 3 or less percent, and you now go to one where you're looking at a band of investment that takes you to a 7%, lower LTV, higher debt service coverage, more like a 4% underwriting on the 10-year treasury or higher. And that's about a 25% decline in value. Look, though, in the bottom left there, what property types had the biggest decreases and it's surprised. So look at multifamily. On a year-over-year basis, the values declined by 20%. That would shock almost anybody going into the end of last year. And what it's telling us, again, is expenses are growing faster than rents. The inflationary pressures are having an impact. And when you put a higher cap rate, it's going to affect values. Look at what happened to net lease and self-storage. It was just 18 months ago that self-storage was up over 60% on a year-over-year basis, and now it's in a decline mode. So we have not yet seen the price correction from all of these interest rate increases and the change in cap rates. And so we have a great CCIM that helped us with this. They did a nice LinkedIn post back in the fall, Greg Hout. And so Greg took us back to a nice simplified version that he's willing to share with everybody of the band of investment. So he looked at January of 2021 and looked at what the cap rate might be from a band of investment. You had 75% loan to value. You had a 10-year treasury and mortgage interest rates, in the low 3% range. And when you filter all that down with your debt and equity, he could construct a case for about below a 5.5 cap rate in January of 2021. Fast forward to October, the fall of last year, and you look at the banks have pulled back on the LTV. Forget 70% now. Think more like about 60% or less. Look at a higher 10-year treasury, higher mortgage constant, higher equity costs, and now you're looking at about a 7 3/4 cap rate. That difference between a 5.4 and a 7 3/4 is about 25% of the value. You can see that down in the lower right there, and what happens to cash flow and the change. That's what's in our windshield. That's what we have to prepare clients for. And that's how, when you take the prior 10 to 15% decline from expenses growing faster than rents, and then put the cap rate change from higher interest rates, you put the 10 to 15 and the 25 together, and that's how we could construct a 40% decline in property values. I don't think we'll see that for all property types. I think we'll see probably something in the 10 to 15% in industrial, 15 to 20 for multifamily, and probably more severe than a 40% for things like urban office in the big cities, and some retail. So that's my forecast on what to look for. Greg did a great job here. So in the SIRE magazine in the fall, I had an article in there about appraisal change. We have a lot of things that are affecting it. And it's not just the change in cap rates, but it's the commingling of what's known as going concern value and market value. And so banks have not paid attention to this very well. And so they've tended to land on the going concern value rather than the real estate value. And so then when they foreclose on the asset, or they have a loan go in the toilet and they go get an appraisal for the as-is market value, they find out the market value is a lot less than the going concern. And a good example of this playing out right now is Red Lobster. So Red Lobster is coming out with restaurant and store locations that they're closing. And their answer as to why is that they're no longer viable going concerns. And that's what we've got to watch for, is these businesses that are operating their business in real estate, and us thinking that the business value is what the real estate value is. And it's not. It's really a big difference. So there's a few other things that we went through, but this is a big one that, with the skills that all of us CCIMs have, we're best suited to help clients and banks and lenders sort out this going concern from fee simple market value. It's a big deal. It's what banks get surprised on all the time in the CMBS market, when they lend on going concern thinking it's market value, and then they have to foreclose or work out on market value. So pay attention to that. The other must read, besides the TREP deal, is the 2023 Emerging Trends in Real Estate. I was involved in the first one at Legacy Equitable Real Estate over 25 years ago. It's just grown in its scope and its value every year. This year's 2023 report may be the most valuable that's ever been produced in its history. So I put up here, where are the markets that are going to perform best according to Urban Land Institute? And then even I put on the housing here. And what you can see is that a lot of the dark green on the left there, the Nashvilles, the Charlottes, the Phoenix, although I'll talk about Phoenix in a minute, Tampa, San Antonio, they're all in the South. And if you look over on the right there in that box I've got, Emerging Trends has evolved and created a matrix that they call, and they distinguish between magnet markets and the establishment markets. And so some of the establishment markets, like in LA or even a New York or Northern New Jersey or Chicago, they've moved from magnet markets down to establishment. They're mature markets. There's not as much growth potential there. It's more redevelopment. It's more keeping alive what you've got. And the new magnet markets, we don't have 24-hour cities anymore. We have 18-hour cities. And they call them the super Sun Belt. Look at the Atlanta, the Dallas, the Houston, Miami, Charlotte, Denver, Fort Lauderdale, Austin, Jacksonville, Boise. These are what they call their 18-hour cities in the super Sun Belt. And so there's a difference. We need to think between magnet markets which are likely to have a lot of growth versus establishment markets, which are more about less growth and is a big market that's kind of trying to sustain itself and stay alive. Housing is going to be tough no matter where you are. And the bottom line is the numbers don't work. You can't get the land at the basis to work. You can't get the materials at the cost that you need. You can't get the lenders to provide the A&D lending for the land and acquisition loans. And so it's a real problem. And there's a big story I'm going to share with you about Phoenix in just a minute. So read this emerging trends report. It takes about 3 reads. It's near 100 pages. It's phenomenal. It breaks out the markets in the states. There's a lot to digest here for you and your markets. And there may be some good material in there for your brokerage packages. All right. The next one, I get my favorite Christmas gift about the first or second week of January every year, which are the moving reports by United Van Lines and U-Haul. So I will tell you for the first time, do not read the United Van Lines moving report. It gets a barbecue sauce award. And here's why. It didn't even have Texas or Florida ranked in the top 10 states where people moved last year. It had places like, Rhode Island and Delaware and, eclectic New England places as the top places that people moved. Remember, United Van Lines moves government and high-end corporate people. So they were probably moving a lot of people out of New York, and they're probably moving a lot of government people around because of the elections. The U-Haul is much more reliable. It has a great history to it. Texas and Florida, again, are battling out between 1 and 2. If you look at the bottom, the top states where people moved, they're in the South or they're the Intermountain region. They're also in a few Midwestern places like Ohio. So this is where the workforce is moving. They're chasing affordability. They're chasing that they can work remote. They can replace a tech job that someone in Seattle or New York says you got to show up every day, to one in the South or inland area that says, no, you don't. and they can still keep their job. So this is a very insightful report. I encourage you to read. And then on the emerging trends, this is one I want to also point out to you. So one of their biggest conclusions this year was something that had never happened in their over quarter century history of tracking and producing this report. And that was that office fell out of the top 3 property types for investment. And guess what moved into its place? Hotels. Boo leisure, Carl, that's just for you. So hotels had never moved up into a top 3 ranking for investment and development prospects. And this is probably the first recession that we're going to see where hotel did not go into recession, that it actually performs quite well. And this is a lot because of COVID and remote work. And so this is a really significant thing. When I was in Hawaii with the Hawaii CCIM chapter near the end of the year over the holidays, they did a great job, got to meet with many of their sponsors and clients, and just tremendous hospitality there. And we talked a lot about this because hospitality and hotels are such an important part of the Hawaii economy. So they were so glad that I talked about hotels and not volcano risk, and they really appreciated this. But markets like Long Beach or David, think of your markets in the coastal regions of Texas, all throughout Florida. This is a big deal for hotels that it displaced office for the first time ever. All right, now for all my friends, including where I grew up in Colorado, the Colorado River Basin states, we know we have this western water drought, and despite the great snowpack and all of the storms that we've had, it would take 5 years of this type weather to make a real dent and fill up many of these lakes and reservoirs, and nobody's willing to bet on it. So what happened at the end of last year is the Bureau of Land Management and the federal courts agreed that the Colorado River Basin states were going to have to cut their water consumption out of the Colorado River. And everybody except California has to cut their water consumption this year by 1/3. California doesn't have to cut it because they have the primary first level water rights on the Colorado River, and the courts couldn't disturb those. But if you're in the lower Colorado River Basin, like Arizona and Nevada, New Mexico, it's a very serious problem. And so you can see kind of the picture of what's happening graphically here, and see, that they've got to cut up to 4 million acre feet of water extraction to get there. And where this hits home, and I know I had some of my Arizona CCIMs complain to me saying, well, we're okay, we're going to have water, we got groundwater. Well, here's how it hits home. So the Arizona governor has just declared that the groundwater needs to be protected in Arizona. And the Howard Hughes Corporation had a massive project in the Glendale Western Valley region that was going to develop over 100,000 homes, an $800 million land investment, spent years going through the entitlement and zoning process, had it all done. We're ready to start pulling water permits. And guess what the governor in the state of Arizona told the Howard Hughes Corporation? No water for you. And so this was just reported on last week while I was out in LA Long Beach. And this is a big deal about what does it mean for the economic development. Now, Arizona and Colorado have done a lot of things to mitigate the water issue. Arizona has been working on underwater capture. So a lot of properties are redeveloped. They collect them in underground cisterns and have an amazing underground reservoir system that allegedly holds almost a year's worth of water. Colorado just got permitted the first new reservoir north of Denver in Fort Collins to help with their issues, but it's just not going to be enough to meet these growth expectations. So many of these states and MSAs in the Colorado River Basin, particularly the lower one, are going to have to figure out what the economic development model is with a whole lot less water. The other thing that people aren't connecting the dots on is the electricity. So in Nevada, about 80% of their electricity comes from Lake Powell and Mead and the hydroelectric dams. And the forecasts are for the end of February that there will not be enough water in Lake Powell or Mead to go over the dam and generate hydroelectric power. And so that's a real issue. What is the plan for electricity use in places like Las Vegas come February or March? Are we going to see rolling blackouts? Are we going to see companies panic? Are we going to see places like Las Vegas fall off the site selection list? We don't know the answer to these questions, but we need to be asking. We need to be aware of this issue and not flame the extremeness of it. But the reality, when you tell Howard Hughes Corporation to go kill an $800 million land investment in 100,000 homes, that's a pretty big reality check in suburban Phoenix. So we need to keep this one in mind in our Western states and what it means for economic activity and growth and investment. All right, let's go back to office. I believe office remote work is here to stay. In fact, the phrase that I've been using and coined at the end of the year was, I think, remote work will be to office values what e-commerce was to big box retail. It's going to be that big a deal. The castle system, which we follow, it's back up the closest it's ever been to 50% of us going back to work. The highest, obviously, in Texas. Chicago broke 50%. A lot of this is because of return to work orders. But just 2 weeks ago, this index was down below 40, it was back below 40. So I use this to really check what's going on. Are these return to work orders effective? So here on slide 25 are some of the return to work orders. The workforce is pushing back. They're moving, they're quitting, they can be laid off, they can find new tech jobs. And one of the great analysis I was reading this morning was these tech job layoffs by, say, Microsoft or Amazon or whatever. The workers aren't going back to those type companies to replace their job. They're going into, say, ABC retailer or other type of company that needs tech, that needs coding people, that needs tech workforce with their skills that they weren't able to hire the last 2 years because of the insane pressures and demand pressures on tech workforce. It's now freeing up to kind of find a natural flow. So you're finding many companies that don't do kind of the normal tech stuff like a Microsoft or Amazon or Apple, that these workers are being picked up on. So I don't think these return to work requirements are going to work or stick, and that remote work is here for us to stay. I think that the office issue is going to be worse in the urban downtown areas like a New York or San Francisco, and it's not going to be so bad in the suburbs. We're seeing really good numbers on absorption, occupancy, et cetera, investment in suburban office space, even here in Atlanta where I'm at. All right, I'm getting kind of near the end. I want to share a couple of things. So one of the things we're seeing a lot of is all the hype and all of the growth around EV batteries and EV car manufacturing. So Argonne and the Department of Energy just produced this report where they looked at where all of the EV battery plants are being made. And around these plants go all the EV manufacturing. And so the red dots represent those. And many of you remember my golden triangle theory, the Great Lakes down to Texas and through the Southeast. And this applies very, very well. Look at all those red dots in really that primary red area in my golden triangle and all those EV battery plants. And around each of those are anywhere from 3 to 5 new EV auto manufacturing plants, whether it's Ford Blue Oval City in Memphis, or whether it's Toyota in North Carolina, or Rivian in Georgia, Mercedes growth and expansion in Alabama, or Hyundai expanding more plants in both Georgia and Alabama. They're all drawing on these plants. The other one, David, is all because of you, from Texas down to Mexico, and then some parts of California down to Mexico. So this is a big picture when you're looking at an opportunity. All of these EV battery plants and their correlation to EV car manufacturing is a big deal. So here's the neat opportunity ahead for CCIMs. With all these EV cars, we're not going to be stopping at gas stations and convenience stores. So we have over 500,000 gas stations with C-stores. What are we going to do with them? What's the adaptive reuse? If we're just driving on by in our electric vehicle and we're recharging at work, or we're recharging, at home and we're not stopping, what is the future and the prospect for all of these C-stores, convenience stores, and gas stations? And that's a question that'll be front and center by next year. And I think the CCIM Institute could really do some neat research, and this is a real opportunity for us. Now, I'm going to close on SpacE-nomics. So this is a real thing. And it's such a real thing that the Bureau of Economic Analysis here on slide 28 is even breaking down the space economy. And they're looking at, it's not just information technology, but it's manufacturing. Manufacturing is satellites and components that go on satellites. It's things like, what are going to be the new leases that go on satellites? Because you can now lease or purchase a tile on a satellite to be your own cloud computing system. So no longer do I have to be a big enough company to launch a $100 million satellite. For under $100,000, I can lease or buy a tile on a satellite to manage all my cloud and my cloud computing and anything that I need up there. And so they break it down now into different sectors, the employment that comes out of government in the space economy, manufacturing, information. They estimated over 350,000 workforce that are involved here. This is bigger than, you can take most couple or three of the manufacturing companies in the country, Procter & Gamble, the General Motors, or a Ford. So this is a very real thing. And so we're doing a lot of work at Red Shoe Economics on this. I was just out in Long Beach. The Long Beach CCIM in Southern California can tell you what's going on in Long Beach with the repurposing of all the former Boeing assets and what they're doing there. It looked like Houston or a Silicon Valley in terms of what's going on at Long Beach in terms of the space economy. So that was a neat field trip that I got to do. I was out there. The final frontier, you can see again some of the companies here. By 2040, the predictions are that we could see satellite broadband in the space economy that right now representing 50% of the market grow to 70%. And on the right there, you can see shaded by color some of the different activities. So look at satellite in the lighter green at the top there. Look at ground equipment. And think about on the ground equipment and all the space economy that's going on the ground to help promote what's going on in outer space. Where's the real estate that they're using? What are the rents? What are the structures? What does it look like? Is it a warehouse? Is it an R&D building? Is it like the biomed R&D stuff in Boston and those kind of expensive things? We need to be figuring it out, because the bottom line is it's about 15% of our GDP, and it's probably growing to 20 or 25%, which would be half of the entire housing industry in this country. So we could see the space economy make up for 50% of the housing economy that's going down right now. Here's some more. This looks at it from a global perspective, and this may surprise people. If you look on the left there, the investments in the space economy, in the space sector, the top 10 countries, the USA just dominates by billions and billions of dollars. China is barely in a billion dollar range. We're at over 8 billion in investments. Look at the number of companies that we've got there in that chart. And then look at some of these companies. You probably have all heard of SpaceX, but how many of you have heard of those other companies down below? And where are their physical real estate? Where are they developing it? Where's their site selection? These are all things that we can use Site to do business, that tool, things like Esri to map these companies and look at the job growth numbers and strip them out of the BEA's GDP breakdown. So this is a whole new arena that really I think the Institute and CCIMs can lead on. This just shows in a little more detail the different industry sectors. So it's not just information and communication. It's even in agriculture, the satellites that help control the disbursement of fertilizer and what needs watering on the different farms. It's in finance. A lot of the banking and finance and insurance stuff is going into outer space and using satellite technology. Slide 32. This shows, again, more of the BEA, the billions of dollars in our growth. The dark blue are information companies and the light blue are manufacturing. But look at the breadth of growth in the space economy by different industry sectors. It's not just telecommunication and satellites to help EV cars navigate and Garmin's work on the Earth. So this is a very real thing that's growing. And so I'll conclude on this. So maybe, David, we can get in a question or two here. Is those of you that were born in the 1950s or 60s will get this. Get prepared to be beamed up to the space economy. Don't get lost in space and miss out on the CRE opportunity. So they can, pitch back to the old Lost in Space episode with forget the name of the robot there, and then the Star Trek where they could beam us up. Very real thing, very big opportunity. It's maybe something to close on positive, because I think we face a tough 2023. I think we're going to be drawn upon by our skills to help our clients, particularly in working out debt where there's no capital and maturity defaults. And so with that, David, I'll stop. I can stop sharing, or we can open it up for any questions. Gina, where do you and David want to go from here?
Yeah, thank you, Casey. We do have a few questions.
Right.
The first one, with all that is going on, what is your opinion of the small business community acquiring real estate assets to purchase instead of leasing?
So what's driving a lot of that is a year or two ago, we finally implemented lease accounting. And so many of you may remember that prior to this change, it took a decade, it seems like, for the Accounting Standards Board to finalize and adopt, was that leases did not go on your balance sheet as a liability. So it was a way to take on liabilities and not disclose it. So businesses small and large were taking advantage of it. That's ended. So you now have to disclose those leases as liabilities. Cleaner to own the real estate and get the depreciation. So many small businesses are realizing that's an advantage that's not just available to the large companies, but small businesses, but it's largely driven by the change in lease accounting.
Thank you. And then we've time for one more question. With the year ahead, you've shared, what recommendations do you have to diversify in the CRE industry, and where are the solid opportunities?
So I think, when you have distress, those are always opportunities. You have clients that need to figure it out. And one of the big conclusions in the ULI Emerging Trends Report was that buyers and sellers can't agree on price. So we're good brokers, we're good negotiators. We took all the marketing coursework. And so really helping sellers realize this isn't a 5% cap rate anymore environment. It's more like a 7 or 8, and helping them with something like a band of investment tool, mathematically see that. I think that's one area in negotiations to help where we're seeing a big disconnect between price. On property types, industrial is still very strong. CBRE just came out with their year-end report, and we had more million square foot warehouse leases than any prior time. And the market that had the most was Southern California. And the reason is that many of the e-commerce and warehouses are realizing that banks aren't lending, merchant developers are having a hard time getting capital, so they might as well snap up everything that's out there. And so industrial stays strong. Multifamily, I think the challenge is going to be the urban areas where rents are being pushed too much and expenses are rising. Anything suburban is an opportunity. The secondary markets in the Intermountain region and in the South are tremendous opportunities. Suburban is where the remote work is. I think I mentioned the gas stations and C-stores. Adaptive reuse is going to come back into focus with all these store closings and big box store assets. And then, I think the other one we're going to see is on the housing front. How do we achieve affordable housing? I'll give you a statistic that came out this morning. And the statistic came out and it said that there are 0 under $200,000 priced homes under development in the United States today. And 10 years ago, that was 40% of the market. So we've got to find solutions, whether it's manufactured housing communities, higher density. How do we navigate all those issues? If you don't solve the housing affordability problem in your city or your state, you don't get rid of Mayor NIMBY, not in my backyard, and replace him with a Mayor YIMBY, the workforce and the industry are going to leave. So when I was out in Long Beach, as much as I was struck by what was happening with the space economy and everything they're doing in repurposing Boeing and all those assets, the challenge you've got is housing. And when I was in Salt Lake, the median home price in Salt Lake now is over $500,000. Where do your ski resort and hospitality and police and fire and daycare workers go for housing? 80% of them can't find affordable housing in the Salt Lake region. So I think housing, solving those, we've seen the for-rent subdivision model crash and burn because private equity got too into it. They took on too much land. You're going to have a lot of these public home builders needing to unwind land positions. So there's going to be a lot of opportunity there. And so those are just a few thoughts I have where we could toy around. And I'm always big on the ports and logistics. The growth is incredible. New York is overtaken. Long Beach is the busiest container port in North America. That's a shocker. Port of Savannah is over 6 million. It's been approved and funded to go to 9 million, which will rival New York and Long Beach. Charleston is still growing, is one of the fastest ports, and they grew all through COVID. Port of Mobile will rival Charleston within 2 years. There'll be over 3 million containers with Walmart and Airbus and all the automobile manufacturing. And Port Freeport, south of Houston, is going to become to Dallas what Savannah became to Atlanta. So there's just tremendous opportunity. If you haven't taken a look at inland ports and the ports and what's happening in the rail mergers, you're missing out on most of the industrial story. So maybe a few thoughts there.
Well, Casey, I mean, amazing information as usual. Thank you so much for sharing your expertise with us today. And thank you again, everyone, for joining us, for attending. We hope that this insightful information is something that you can use in your everyday business and something that you can bring back to your clients. As a reminder, of course, this recording and its accompanying presentation will be emailed to all registered attendees. So look for more information coming soon also about our C5 plus CCIM Global Conference, and we will see you at the meetings in Boston in April. Thanks so much. Have a great day. Bye-bye.
Bye.